What goes through your minds when you're about to push that button?
I think it's very important to think about it in percentage terms, actually, because if you think about it in millions of pounds,
Mm.
and then you think about that in relation to your own situation, you would
Yeah,
freeze
yeah,
Yes, good
and
point.
think, wow, I'm about to put, pick a number, 2
yeah.
million, 5 million, whatever, into this. And that would be quite scary. So the sanity in professional fund management is around actually thinking in percentages. It's not that we're irresponsible, we're absolutely not. But in terms of trying to not relate it to everyday life, it's much easier to just think in percentages.
Hello and welcome to Investing for the Long Term with Judith Mackenzie and Rosemary Banyard. Judith is partner and head of Downing Fund Managers, and Rosemary is an award-winning fund manager who manages the VT Downing Unique Opportunities Fund. In the previous episode, Judith and Rosemary share the highs and lows of meetings with company management, red flags to look out for, and their views on annual general meetings, also known as AGMs. And during this episode, Judith and Rosemary share how they construct a portfolio of stocks and then how they manage them. This was another great insight into how two seasoned fund managers think and how they view investing for the long term. And just before we get started, please remember that all opinions and information are for educational purposes only and do not constitute investment advice. Investing carries a high level of risk and is not right for everyone. Always do your own research and seek financial advice from a regulated financial advisor in your country before making any financial decisions. With that being said, let's get started. Hello, Judith. Hello, Rosemary. Good to see you again.
Hi, Lee.
Hi, Lee.
So I thought we'd start off with, what does portfolio construction mean? For the person that perhaps is listening to this for the first time, how would we explain to them what portfolio construction is?
I think I might answer it in shaping the question to what I want to answer. What's the way to do it? Why have portfolio construction? And I think in very simple terms, it's about not having all your eggs in one basket. And that means if you drop that one basket, all your eggs might lose their yolks and you don't want to be losing pounds and pence. So it really is about spreading your investments across a number of baskets so you're not overly dependent on any one thing. So that for me is why it's worth having a portfolio approach. I think when I started off investing at first as an individual, probably quite conviction led, and I would just find one or two things I wanted to invest in and put all my eggs in those baskets, and probably relatively quickly learned that if one went down, then it could drag the other profits that you might have made in the other one with it. So therefore, having a measured portfolio approach helps you be able to maybe spread risk. Don't like using that word too much, but helps you spread that risk. And hopefully, if you do it well, allow you to maximize the returns from the ones that are doing well and minimize the losses from the ones that maybe don't go so well, understanding that a good fund manager will typically get 60% of their calls right, which means 40% will not go quite right.
So what would you say then is portfolio management? Does portfolio management blend in with portfolio construction then?
Yes, I suppose it does ultimately, because you might construct your portfolio on day one, but you don't just sit there and leave it because it's a live and growing thing. You get news flow coming through and share prices react to that news flow and they react to market sentiment. So I suppose when we're talking about portfolio construction, what we're doing is trying to figure out how many stocks you want in your portfolio. And that in itself is a debate that we can have. And then the weighting of how you put your stocks in the portfolio. If say you've got 20 stocks, do you equally weight them throughout those 20 stocks? Or do you have some that are slightly higher percentage of the portfolio because you are conviction led and you might believe in those stocks a little bit better? So that I suppose is part of the portfolio construction, but then also will lead into the portfolio management, because if something goes up by 20% and you've got it in at 5%, are you going to take profits in it, or are you going to let it run till it gets to 20% of the portfolio? Portfolio management aspect of it is different to portfolio construction because you're dealing with the portfolio. I suppose it matures, but it's the same concept, because you might start off by saying these are the percentages that I want in each one of these companies, but they're not necessarily going to stay there on a day-to-day basis. That's where the portfolio management comes in.
And yeah, you've got to also face the fact that some things that you will invest in go wrong. And then you've got decisions which I would characterize as double or quit on those. And it happens to us all. Again, that's part of a decision around portfolio management. Or do you cut your losses and go and find something else? So yeah, it's all those sort of decisions we're considering.
If someone's sat now listening to this and they're thinking, okay, how do I even go about constructing a portfolio of stocks? What would be the steps or the parameters that they would have to consider?
How many stocks you want to own? I Googled this and every answer came back saying the common norm is for portfolios of stocks to be between 20 and 30 positions. And I couldn't find out where that common norm actually came from. I think there was a study done back, a US study done back in the 1930s that said that you can get diversification at about sort of 20 odd stocks. For me, I don't want to own too many stocks because I want to be able to know them as well as I can. So I don't want to have 100 stocks and have to learn 100 stocks, do diligence on them and then follow them. So the fewer the better. For me, the mandates that we run, they're probably are looking for perception of lower risk. So they like to have slightly more than maybe I would say at 20 odd positions. But so we're running mandates of between 25 and 40 stocks. We own 28 at the moment. And Rosemary, very similar, isn't it?
Very similar for me, yeah. Almost identical. Yeah.
And that for us is comfortable.
Yeah, it's because the monitoring cost is what you're describing, Judith, and that applies to an individual as well as to us. So it's very easy, and you sometimes see this if you look at the Investors Chronicle. They have a feature every week, don't they, looking at somebody's portfolio of funds or stocks, and they have a couple of advisors making comments. And sometimes you see quite a nice, tidy portfolio with 20 or 30 names. And sometimes you see somebody who's got 50 or 100. And I would say that's probably out of control. And normally the advisor will say, you've got too many things. You can't possibly keep tabs on all that.
Yeah, that's very true. That feels comfortable for us. Some other people might prefer more, but that's where we're comfortable.
So do you see you're mandated between 25 to 45? Is that a regulatory requirement or is that an in-house Downing mandate?
No, that's what I said.
Right. Okay.
But I say mandated. I suppose that's what we tell investors, so we stick to it. But it's a good thing because that's what both Rosemary and I, when we create the mandates in the first place, it's what we're comfortable with. So no, that's not a regulatory perspective. In fact, there's nothing regulatory apart from sometimes the vehicles that you run will have concentration regulations.
It depends, Lee, actually. I think some of the funds Judith's thinking about, that's true, but the particular fund I run, the number of holdings is in the prospectus. It says 25 to 40. So it has to stay within that number because it's in the prospectus, unless we want to go and change the prospectus.
That was a number that you wanted.
Oh, you chose, yes.
We chose it. Yeah.
Okay, so once it goes into the prospectus, then it becomes
That's
a
it. It's right.
Yeah,
exactly. Yeah. Fair point. Yeah.
Understood. So, it may seem like a silly question. Can we just put 25 tech stocks in that fund?
Yeah, can if we want.
Yeah,
I'm sure I've done very well.
Exactly. That's what I'm thinking. Just buy tech companies.
So,
in all seriousness, though, I know we wouldn't do that.
Some people do. And I suppose we're talking about diversification. The first, I suppose I was trying to answer the question in bite-sized chunks. So the first thing is how many companies. Then you've got to decide whether you're going to be a specialist in some way. Both Rosemary and I invest in smaller companies. So in a way, we're already narrowing down. We think it's pretty wide actually, but we're focusing on one particular area. And then you might think about market caps. So that's another way that you might think about segmenting the area that you're looking at. And you might do it by theme, technology or whatever, or you might do it by geography. It might be a global fund or it might be a UK fund. So there are actually, once you've decided how many stocks to have, you can then start deciding how specialist you're going to be.
Yeah. A fund manager, there is also a question around how much cash you want to own. And that can vary. That is certainly in the open-ended investment company rules, limited by the rules to 20%. But different people hold different amounts of cash. It could own just 1%, or they might own quite a lot. It might depend on whether they're feeling positive or negative about the market. So for a private individual, I think that's also a question, is how much you've got to think about how much of your money do you want to be readily accessible for emergencies. Fundamental principle that you probably need a bit of money to be kept aside in the bank or government bonds or something that's near what we'd call cash or near cash. So there is something that needs to be thought about there. And then, as Judith talked about, people have specialisms and sector specialisms. We don't have restrictions on how much we can put into different sectors. So we could, in theory, have a 100% technology fund, but there is against that the need for spreading your risk into different areas of the economy. You tend to find that at different times, certain sectors are in favour or not in favour. We can categorically say that no sector remains in favour the whole time. So be careful if you think if it does. And yeah, so I think it's definitely something for people to consider. And everybody probably has better knowledge about some industries than others. I certainly do. I think it's true to say I've never actually ever in my whole career invested in the mining sector, and I've very rarely invested in the oil and gas exploration and production sector. And when I have, I've found that it's been very difficult and hasn't been a lucrative experience. I definitely have sectors that I feel more confident, more knowledgeable about, and sectors that I feel a lot less comfortable with. And that will be true for everybody, I think, depending on your experiences in life, your job, whatever.
Yeah, I echo that. I don't invest in things that I can't understand. Really, I think that's quite a good rule for me, given some of my past experience. So I don't invest in banks because I don't really understand them. Don't invest in mining because I'm not a geologist. Don't invest in early stage biotech. I think and technology. Early stage, I think, is very difficult to forecast. And I think when you're trying to build a portfolio and you're maybe putting in conviction holdings a bit like we do, then you want to, the main thing underlying that is that you want to be able to forecast them relatively accurately. So if something's loss making or coming into profitability and dependent on technology being adopted, then I think that's very difficult to forecast. So we tend to stay away from unprofitable companies as anything too groundbreaking. So really echoing what Rosemary's saying there, it's really just trying to stick to what you understand, and your own biases will end up pushing you down certain routes. I really love widget manufacturer. You can go out and see the factory, kick the tires, and to really see the cradle to grave of what they're making, and hopefully understand the end user and the end buyer as well. So you see the whole life cycle of that product or service.
It's quite interesting because when I listen to you there, the different parameters, cash, how many stocks, specialism, sectors, there's no real hard and fast rule on this, is there? It's very much you are creating your own parameters.
Yeah, I think I would urge people to think about it, because a bit like Rosemary's created her own mandate and fund, it's now in a prospectus. That's what most fund managers end up doing. And I suppose it's the discipline of thinking about where you want to invest and then having that portfolio management, the portfolio construction question round about it. It makes you think about where you really want to be and how you differentiate yourself. We are investing in companies under 500 million market cap because that's where we see value. We're investing in UK AIM companies because, again, that's where we see value. And then we hunt for we do it bottom up. AIM is in terms of the percentage in each sector. We are completely agnostic as to what the index says. So we'll just go out and find the best ideas within that universe and the best 25 to 30 odd companies that we can find. So I think it makes your job a lot easier if you put the portfolio construction question almost first and find out where you're comfortable. And then it helps narrow your universe. So hopefully you can find the best people, best companies, best management teams within that universe.
We've touched there a lot on portfolio construction, all the different sort of rules and parameters that are involved in portfolio construction. What are some of the risks that investors should consider when constructing a portfolio of stocks?
Yeah, this is a really interesting question, the question of risk. And it's something that anybody who goes to see a financial advisor or a wealth manager will get asked about, because that is the regulation now. And one of the first questions you'd be asked is what level of risk you want to take with your investments. And the comment I'd make on that is that the definitions of risk in that question, which are driven by the regulator, relate quite a lot to volatility. And so that obviously is how much different share prices wing around, simply. So in answering that question, you need to think about two things, I guess. The first is your own equanimity in the face of movements in the value of your money, whether you can cope with some wider movements from month to month and year to year or not, but also whether you have requirements for capital, for cash in the foreseeable future. Because one of the challenges about investing in shares is that if you think you need some money in 6 months' time or 9 months' time, then you need to be careful not to invest in something which might suddenly plummet and it comes at the wrong time. So that is why they ask about volatility. And there is also the fact that you can measure it, historically at least, with individual companies. You can measure how volatile they've been. But there are many other types of risk which are not front of mind, but should be considered. The first one is inflation. And we've obviously had a bit of a dose of higher inflation in the last year or two, which has brought that particular risk back into to front and centre. But I think it's always been risk that people should consider, because talking eventually about the purchasing power of your money, and I think most people would want to keep that, to at least maintain that. That needs to be considered is how you might keep up with inflation. I would make one general comment, which is putting your money in the bank probably won't do that for you most of the time. Quite an important point. Another risk that we consider as fund managers is the risk of total capital loss in an individual investment. And we've talked about this in a previous podcast about some of our mistakes. But it is important to know, whether you're looking at a fund or whether you're considering investing yourself, whether you're willing to tolerate some of the companies you invest in just going bust. And Judith just mentioned about loss-making biotech. So often with a company like that, the risk is binary. Either they're going to have something that gets through the regulations and launches, or it's going to fail and it's just a failure. That's a binary risk. And if a loss-making company has some of those, it could just go bust. So you've got to decide when you're investing whether you're willing to take that risk in a few situations, or whether you just want to focus higher up the quality scale with well-funded businesses. That's another important risk, I think, for people to consider. I think the third one is currency risk. So if you're going to invest it outside your home country, you are going to, somewhere along the line, be bearing a currency risk compared with maybe your outgoings, which may be in your own home currency. So it's just worth being aware of that when you're investing, I think.
Yeah, Rosemary put that very well there on articulating risk. I try and take that and almost simplify it a little bit as well, where it goes back to one of the points that Rosemary made. Share prices will be volatile, or can be, most likely will be volatile. So you've got to understand your own ability to tolerate that, and looking at share prices on a daily basis, whether that's going to make you uncomfortable or not. But if you're investing in the fundamentals or something, then actually the share price shouldn't really matter. You're investing for the long term, and you've got to find a way for those fundamentals, the intrinsic value to come through. That volatility shouldn't bother you so much if you are conviction led, and on bad days you buy more of that stock if the price was down. I think risk for me, when I'm thinking about it, ties all the things that Rosemary has just talked about: interest rates, inflation, etc. I'm thinking about my tolerance to risk is really driven by that thought of it being a permanent loss of capital. Am I prepared to bet on this company if there is the threat of a permanent loss of capital? And permanent loss of capital tends to come about by the company having debt and you not being capable of being able to be in the driving seat. For me, I look at our portfolio, our tolerance to debt is exceptionally low. We either like to have net cash in the balance sheet, so that's a nice buffer, or where there is debt, there are some really hard assets that you can see that you can value that back up that debt. So not really taking debt on the basis of on an earnings basis. It's really purely on either assets or not at all, actually. So that for me is where I probably look at a portfolio and it lets me sleep at night.
So how then do you assess the different weightings of the companies and how they impact each other of the stocks that you own?
Yeah, I think there's two questions there. So there's how you assess the individual companies that you might want to own. This will vary from individual to individual, depending on your understanding of accounts and industries and businesses. But as we've, I think, discussed in previous episode, I certainly focus on the cash flows of the business and valuing those. And as Judith said, prefer companies with either little or no debt that is manageable, because they've got lots of repeat contracted revenues that give them visibility. And I think how much of your portfolio you put in a particular company, it is personal taste, but there is an argument saying you could have similar weightings in all the companies that you choose to own. And I have some sympathy for that view. The argument in favour of that would be that you don't know at any given period of few months or whatever, which of the companies you might choose to invest in are going to have good news, perhaps surprise positively, and then maybe go up in value and other investors want to invest. You probably don't know when they're going to appreciate in value. Having a what we call a fairly flat structure has some merit. But there is also the view that you might have certain companies in your portfolio where you really have strong convictions, either that they're going to continue to grow and take market share and do really well, or they're in an industry which is booming, or it could be that they're very cheap and you think they're really undervalued and they've got huge potential to be revalued. So for all sorts of reasons, you might have very strong convictions. There's nothing wrong with that. You can choose to, what we would say, double or triple weight such a company compared with what your average might be in your portfolio. And the other question is around how different weightings impact each other. We have rules in relation to funds which are to do with concentration risk. So there's this rule which is for UK open-ended funds, it's called the 5-10-40 rule. And so this rule is that no individual company can be more than 10% of the portfolio, and that the top 5 shouldn't in total be more than 40%. So it's fairly easy to understand, 5-10-40 rule. I think although some people get frustrated by it, I think on the whole it's a protection for investors against too much concentration. Because at the end of the day, you never know, do you, when there's going to be some news item that comes out that's going to hit a company from left field. There's always that risk. And so investors in funds are protected by that rule to some extent. Speaking personally on that, I prefer not to own stakes that are close to the 10% level, because then if a company does well, shares go up, they go through the 10% mark, then you are forced by the regulations to sell some shares. And sometimes people can see you coming when that's the situation. The market knows often when someone's in that situation. So I would prefer to avoid, as a fund manager, getting too close to that line and being in a position of being a forced seller. But there are people who disagree with that. But of course, as an individual, you're not bound by those concentration rules. So you could have 5 companies in your portfolio, 20% of your money in each. But in our world, that would be considered quite high risk.
What do you do, Rosemary, in terms of, or how do you think about position sizing? Do you have any rules, not rules, but even self-thoughts where you think, okay, you put something in initially at a certain percentage and then you maybe have your model portfolio such that it is running up to maybe 5% position, or
it's something like that.
It?
So I would say, obviously, having got what would be called a fairly concentrated fund with just under 30 holdings, for anything to be meaningful, it's got to be really 2% of the fund. And then at the other end, I probably start to, because I'm quite cautious, when something gets to, say, 5%, it's not hard and fast, but I would probably maybe start to trim it because it will have done well probably to get to that level, go and add to something that's done less well and is looking cheaper. But every single person will have their own sentiment on that, depending on their, just how cautious or not they are.
Yeah, so we're in it initially probably 2.5%, and then our conviction holdings are up to 5%, slightly bolder than where you are. But what we do, we've got our own internal process where we're monitoring all clients to see if that 5% gets to 7%, then we're trimming back. So we won't let that 5% run to a 10%, for instance. So you've got to make sure you're getting your conviction holdings at 5% right. But it tends to take quite a bit of time to build to that 5%. We're not doing it overnight. We never put something that's new in the portfolio in at 5%. That would be bold in our view.
Could I ask at what sort of position size do you start off at? Is it 0.5%, less, 1%, 2%, or does it vary?
I think, as Rosemary says, everything has to earn its keep in our view. So it's almost a bit like if you're having a portfolio and we're seeing 28, 30 companies, if we find a better idea, it's going to displace something in the portfolio. So that really makes you think, okay, what's not maybe going to do as well as we think? That's the one that would end up getting displaced out. So it means that you're being very disciplined in making sure that everything you think is going to contribute is there. So if you want something to contribute, I agree with Rosemary, you're not really going to be putting it in at 0.5% or whatever, because it's not going to move the dial.
Is that too small then?
Yeah, probably too small. But if you're putting in at round about 2% or 2.5%, then it's got a chance of actually influencing something. There's nothing worse than putting something in at 0.5% and it does well, and it goes to 1%. But if you put it in at 2%, then it would have been at 4%. It's got to contribute overall to the portfolio, not just be a name on a list.
And equally on the flip side, if you're going at 2% and it drops to half, it's not enjoyable, but it's only 1%, isn't it?
So. Exactly. And you've got the choice at that point as to whether you buy more and take it back up to 2%, or you think, oh my goodness, I got that completely wrong and I'm selling it. And I've had both instances many a time.
Me too.
Yeah, and I think we've touched on that in previous episodes. And listening to you, it really demonstrates to me how the previous episodes really have all accumulated to this now, where we are discussing the actual construction and the management of the stocks. You are right. You have touched on many of these points in previous episodes, done entire episodes on some of these points you're touching on. But it's really quite interesting just listening to how it all fits together now. Just thinking as well, you've got your parameters in place that comes in part from a regulatory or self-governing rules that you've created. There's some regulatory sort of rules that you've got to think about as well. But when thinking about different sectors, what sectors would one need to think about that cross over multiple different sectors when you're thinking about risk?
One sector I think that is maybe not always obvious, but is the exposure to the consumer. And I'm not just talking about going down the high street, because we quite deliberately don't have much high street exposure because of online and other influences. But actually, is that widget manufacturer making something that goes into a mobile phone that ultimately will end up in a mobile phone that's got a consumer aspect to it? So I think that's maybe quite a good thing to think about, because most things tend to get driven by what we're buying or needing or demands or services that people have. So just thinking about that end buyer of the product. It's not always just a big multinational. It might be a big multinational that, as I say, is servicing some kind of consumer demand of some sort. So that's probably quite important for us. That being said, I've never actually sat down and said, okay, I'm going to build a portfolio and I'm going to look for this sector exposure. We've always done it bottom up and finding good quality companies at the right price, and then making sure you don't stumble on having 10 companies in one sector. And the good thing I think about AIM and small cap is that the companies within it are really very diverse. If you looked at our overall indus sector exposure, it might say industrials. But that's got everything from a company making cables for renewable industries right the way through to a specialist, almost quasi software. You really need to look at the individual company exposure as to what kind of, as opposed to what kind of badge it might have on from an index level. And for instance, I've got two companies that are in slap bang the same sector. They're two pawnbrokers. So one is called H&T, another one's called Ramsden's. Why on earth am I doubling up on that exposure? It's because although they're both in the pawnbroking industry, one is nearly 100%, 80% pawnbroking in the southeast, whereas the other one is 30-odd% and it's in the north. So completely different demographics. And also one is selling FX for you going on holiday, and the other one's got a tiny bit of exposure to that. They both got exposure to secondhand jewellery. So I've got to think about the retail environment there and whether people are going to be buying secondhand watches, and what's the difference in somebody going into that shop in Middlesbrough as opposed to somebody going into that shop in the H&T in the southeast of London. So although I've got the same exposure on a headline basis, I know that the demographics, the way the business is run, the gold exposure, etc., is completely different. So that's almost going contrary to saying that you shouldn't have too much sector exposure.
It's interesting. So I've got something around 20% of my fund in technology. And so you think, gosh, there's that a big risk. But it's mainly consisting of companies producing software. And they are generally in the area called vertical market software. So they are specialists in a particular industry. And so, for example, I've got a company, Alpha Financial Software, which supplies the leasing industry worldwide. I've got another company, which Judith also owns, called Traxis, which is supplying software which runs an awful lot of the UK's rail network. So they're both software companies, but they have completely different end markets. And so that is a perfectly sensible diversification. My fund, because it's got the word unique in the title of the fund, the definition is that the companies in the fund should be unique, either the only one doing what they do in the UK market, or if there's more than one, this particular companies must have a very distinctive strategy and culture. So that the very title and the very rules around unique protect me from too much crossover.
You said there you've got like HT&T and Ramsden's, they're both pawnbrokers. But actually, you've looked at them individually,
yeah,
and they're actually one's in the north, one's in the south. Not completely, but mostly. One generates a large percentage of its profits from FX, the other one not so much. So even though they're in the same sector, they're actually diversified. Would that be a fair comment?
Yeah, definitely. Yeah.
Equally as well, the way Rosemary just described there with the stocks in the technology. Yes, she's got 20% in stocks, but looking at them as individual companies are actually serving different markets.
Absolutely. Yeah. It's bottom up, as we call it. So that's looking at the stock first, then thinking about that sector exposure.
So instead of thinking, oh, I'm going to buy 5 stocks in this sector, 5 stocks in this sector, 5 stocks in this sector, you actually start from, let's find good stocks first.
Yeah.
And then see what sectors they're in, who do they serve, what's the potential customer base, and as you say, bottom up.
Yeah.
So what do you do then when a company becomes overweight or ends up becoming a large percentage of your portfolio?
Probably trim it back down to take profits and take liquidity in it and trim it back down to whatever position you feel is appropriate at that time. Or if it's done really well and it's hit your price target, you say goodbye and recycle your profits.
Well, you do set
Nice
price
problem.
targets then, do you?
That's based on free cash flows, discounted cash flows, some of the things that we've already talked about. So yeah, we're setting price targets of what we believe the intrinsic value of the business is. And then once it gets close to that, then we start taking profits. And take profits or also probably sell it down unless something fundamentally has changed to make you change your price target. I think the one thing about fund managers can be quite good at just saying, oh, a stock's doing really well, so therefore if it's going up, it must continue to go up. I can promise you that doesn't necessarily happen without the fundamentals being in place. We're quite disciplined that if you are changing your price target, you're doing it for a very clear reason. And my colleague Nick would pull me to account if I was just changing the price target on something that had gone up another 20% or whatever without the fundamentals being in place. Yeah, it's good to have that discipline. Ask yourself why you'd be changing the price target. It's got to be because something has fundamentally changed, beat your expectations, or there's some new news flow out that has allowed you to up that share price target.
On the other side of that is that, of course, a number of the companies that you own will quite likely go down in price. But if nothing else has changed, it could be some sort of short-term sentiment thing in the market, or it could be a trading update that's just in line, but people have got bored and somebody feels that they're going to sell a bit, and a liquid market and shares drift off because there's no news. These things happen regularly. If you know your companies well and that they've drifted off and there's nothing really fundamentally wrong, then that's the time to go in and add more. It can be a very successful strategy.
Which is why it's quite nice having a bit of cash for ready to go, as you said at the start, Rosemary.
Yeah, that's an interesting point there. What's the take on how much cash should one have on hand? Is there an industry average, or again, is it personal choice?
I think it's personal choice. I think with funds, very often fund buyers, so the investors in our funds that maybe aren't individuals, but institutions would say that they're paying us to invest in the sector that we invest in. So it's their decision as to whether they hold cash for a client or not. So they probably want us to be relatively fully invested in our best ideas. So there's that element. But at the same time, I think you balance that with being able to have firepower for those bad days in the market where you want to be able to pick up stocks at the wrong price. We would typically run at anything between 2 and 5%, sometimes higher, but our investors tend to want to be fully invested. You might have a bit more latitude, Rosemary.
Yes, but I think quite carefully about holding more than 5% for the reasons you've just said.
Listening to you as well, it becomes more clear of why having too many stocks, it becomes too difficult to manage. You can see why 45-ish cap is a good limiter, really. I mean, you usually have teams, do you have teams helping you with these funds?
Yeah, but in the end, it's us. It's us pushing the button.
Yes.
That's the job of a fund manager, the joy and the pain of it as well. So, I think the one good thing about the way we manage money is that it is conviction led, and we don't have a chief investment officer telling us what themes we should be thinking about or where to be going with things. We are the ones that are pushing the button. And although we work with other colleagues, ultimately we're responsible. But again, I think even with a massive team, if you're the ones pressing the button, you're not going to be close enough to it if you've got 100 odd stocks. So you can't delegate responsibility. Well, you can, but you've got to then understand what you're delegating and the detail behind it. We're not control freaks, but we're probably pretty close to it.
Rosemary, would you say you're a control freak? Or should we ask your husband on that?
I definitely like to be up to speed on all the companies I own. If that's being a control freak, then yes.
Yeah,
I get quite worried if there's. I find the results season is quite difficult because we inevitably get 10, 12, 15 companies reporting in the space of 3 weeks. And then I don't like the feeling that you suddenly aren't on top of them all.
Yeah. That's probably the one thing that stresses me out more than anything. Like, stocks go up, stocks go down. But if you feel as though you're just a little bit behind the curve and getting the full knowledge of what you perceive to be the full knowledge of something, it's not nice, which is why we manage the size of portfolios that we do.
In terms of when you're thinking about pushing that button, that first initial buy, going back to when I bought my first stock, the thoughts and the fear, the panic, the kind of the worry, and I know many new entrants to the market suffer from this, but yet here you are right at the top of the pyramid, managing hundreds of millions. What goes through your minds when you're about to push that button?
I think it's very important to think about it in percentage terms, actually, because if you think about it in millions of pounds,
Mm.
and then you think about that in relation to your own situation, you would
Yeah.
freeze
Yeah, okay.
Yes, good
and
point.
think, wow, I'm about to put, pick a number, 2 million, 5 million, whatever, into this. And that would be quite scary. So the sanity in professional fund management is around actually thinking in percentages.
Mm.
It's not that we're irresponsible, we're absolutely not. But in terms of trying to not relate it to everyday life, it's much easier to just think in percentages.
Yeah, that's a very good advice, Rosemary. And I never really try and relate it back to anything in the day to day. It's a big deal, don't get me wrong, but I think you should be buying a stock and you're feeling actually quite good about it. You've done your diligence. You think you've covered off as many angles as you can. But importantly, you're not blindly doing it. You're not thinking this is a great stock and it's only going to go in one direction. You should have a good idea as to what will influence it on a negative as well, and what the red flags to look out for in the journey of owning that stock. But generally, for us, sometimes we've done 3, 4, or 5 months worth of work on it, and you feel as though, for us, if we feel as though we know it better than any analyst that's out there and have a good understanding of the management team, then that gives you as much confidence as you can ever get, I think. But you're always going in knowing that there is downside, and trying to be able to quantify that downside and understand where that downside risk comes from never gives you that exact warm feeling, but it at least allows you to know where that black swan event might come from.
And don't think about the money. Think about percentages.
Exactly. Don't think about the money.
Another great insight there. Absolutely brilliant.
Yeah.
Thank you. So, we talked a lot about how to do it, the kind of the advantages of portfolio construction management. What are the constraints? What's the downside to it? If there are any constraints?
Not really. I mean, sometimes, as Rosemary's mentioned, some of the regulatory aspects that are there with the 5-10-40 rule and concentration, but I actually think those are quite healthy rules to have. So I don't really see the downside.
Actually, I'd say there is one constraint which frustrates us, and it's understandable why it's there, but there is a lot of monitoring these days of liquidity
Good point, Rosemary.
in companies in the market. And this is typically expressed in the industry as number of days to exit a position. And it's analysis that we have done, every fund will have done. And it is based on past trading, so it has its limitations anyway. And you'll get a picture then of your fund and what percentage of your fund can be exited within 4 days, and then what percentage could be exited within 10 days, or whatever it is. And because we're both investing in some smaller companies, there'll be some, in theory, take longer than that to get out of. And this is all monitored. It's an industry sort of standard monitoring. And I absolutely understand why it's done. And some of that is higher up the agenda these days because of the Woodford saga, which most people will know about, but that it is sometimes a constraint, particularly in an open-ended fund. You want to invest in less well-known companies, less well-researched. They tend to be at the smaller end. Therefore, they tend to be in that take longer to get in and out bucket. And that's a constraint which is not faced so much by the investment trust sector, which people can't just withdraw their money from the fund in the way that they can in the open-ended sector. Yeah, I think that's a constraint sometimes.
Did those rules come around after the Woodford collapse?
They sort of stepped off that sort of daily monitoring. And I think we invest in microcap companies, and a lot of these companies deal by appointment only. So it's a bit of a farce looking at historic liquidity, because we work quite a lot of our liquidity. So if it does frustrate me that we're sitting down in front of a risk and oversight committee that's telling me how many days that it's going to take to invest or divest out of our portfolio, and actually I find that if I make 2 or 3 phone calls, I could probably get liquidity that would knock those numbers out the park. But that's life.
The rules are usually reactionary, aren't they? And they normally come off the back
Yep.
of a situation that's occurred.
Oh, yeah, always are. Yeah, and those tend to be the worst ones.
Yeah. So what sort of tools can one use, or are there any softwares out there available for people to use to manage a portfolio of stocks? How can they make life easier on themselves? Or what software tools do you use as well? What do you use?
Yeah, we call it Excel. Our workbook in Excel. It's dead
Just
simple.
something as simple as that, then. Eh?
Yeah, get your stocks on one side, the number of shares you own, add them up, the value, and look at the percentages. There you go. That's it
Yeah.
done.
Important there as well. You said percentages,
Yes,
not the
value.
pounds,
Yeah,
not the
we
value.
did that first. Yeah.
Yeah.
We have deal management software so that when we're placing deals,
Yeah.
it will recalculate percentages for you based on the order that you put in.
So you
But-
don't make them, don't press the wrong button and put a 5 instead of a 6 or an 8. I had put an extra 0 on by accident sometimes when I'm placing orders, and it's a horrible moment.
And it will stop
Yeah.
you selling something that you don't own,
Yeah.
which is also dangerous.
It's
But
yeah, we're lucky we get a daily valuation that comes through, so we can see any inflows or outflows into our funds, and we can decide whether to react if we've got inflows and outflows. And we can see the percentages down the other side, and yeah, it's something that we look at on a daily basis, a number of times a day, maybe.
Again, another really insightful episode there. And I think this one really demonstrated to me, like I said earlier, it's the accumulation of the previous 6 episodes that really bring it all to bear of what it means to be a fund manager and to invest privately if one wishes to. Looking forward to next episode, which will be on a day in the life of a fund manager. What do you do on a day-to-day basis? That's going to be interesting.
Look at spreadsheets, that's what we do.
Yes. I think we can probably surmise it's research, analyze stocks, and study
Yeah.
spreadsheets.
Yeah.
So as we always finish off with the question of a book to read or a podcast to listen to.
Well, I was going to take a leaf out of Judith's book from last time, actually, and go for an annual report. And I'm going to suggest that people might find it interesting to read the annual report of Games Workshop. It's been one of the UK's most successful investments over the last 25 years in terms of the stock market. And it's very interesting. The annual report, unlike most, is in black and white, no pictures, never has been. I've got many of them on my shelf and they all look the same. But if you delve in, and you don't have to read the whole thing, but if you just read the first 10 or 15 pages, you can tell that it's written by people with an absolute passion for the business that they run. It's not conventional. It tells you exactly what they're thinking, what they're planning. It's all the more remarkable because the people running it actually they don't have huge stake in the company, but they have a huge emotional stake, I would say. It shines through. And so it's because it's so different from most of these very similar annual reports with lots of glossy pictures, but really an awful lot of boring text. I commend it.
That's interesting, isn't it? You say they're one of the most successful companies of the last 25 years. I wonder how many people have actually heard of it. I would probably argue that not so many.
If I said Warhammer, that might up the
Yes.
number because that's what does it trade under.
Yeah.
For their tabletop fantasy war games.
Yeah, a few people have probably heard of the actual forward-facing consumer brand, haven't they? Warhammer, the actual company behind it.
It's interesting what you say there, Rosemary, that I hadn't thought about it, but Next don't really have many photos in their quote accounts either. And it is all kind of black and white monotone. And when they put in graphs, it's from Excel. It's nothing fancy. It's not been through a design agency or anything. And you're saying Games Workshop are pretty much the same.
Yeah.
You think about Warren Buffett reports as well. It's just words, isn't it? In Times Roman font.
There's no photographs of the directors.
Yeah.
No egos.
Nice point.
By you, Judith?
It's an interesting one this time. This maybe sounds a little bit sycophantic, and I don't want it to be like that. But I think in fund management, it's always quite good to have other fund managers who you respect and who do things maybe slightly different to you, but still make very good returns. And one of those fund managers is a gentleman called Christopher Mills in Harwood Capital. And if you look at his returns over the last 20 odd years, in fact, he's had 30 years in one of the funds that he's been running and over 15% compound return. So he's doing something right. He's a bit of an activist shareholder and a larger than life character as well. But he commissioned a book and it was about his father. And he actually only found out about his father's story in the last 20 years when his father was in his 80s. And it's a book called The Spy Who Came In From the Cold. And it's by a chap called Christopher Andrew. And Christopher Andrew was the former official historian of MI5 and also wrote quite a lot of Russian espionage. And he tells the story of Cyril Mills. And Cyril was Christopher's father. And it's quite a bizarre but entertaining, intriguing story because Cyril was actually a showman in his father's circus, which was the Bertram Mills circus that was actually around for about half a century. And you go back to the days, and probably before your time, but circuses used to be quite a big thing when they came to town, and it was a place to go. And you've got photos of Churchill and others at the Bertram Mills circus. And he worked in the circus for a while and sourcing horses from Russia or whatever. But he then became a spy, and he was a spy for 40 years without his family knowing about it.
Wow.
And he also recruited Garbo, who was one of the world's best double agents during World War II. And this book tells the story of, I suppose, life in the circus, life as a spy, espionage, Russian espionage, and really quite a fascinating life that had been kept undercover for so long. How does that relate back to finance? But this is Christopher's father. And you can see quite a few of the traits of this hero of the day who'd fly off in planes across various frontiers and be carrying out spy activities, but at the same time be going back home and being the ringmaster in his own circus.
Sounds like a Hollywood movie. Sounds like
it does. I think it will be.
Yeah.
The book only came out in the last couple of weeks, and I think somebody's going to grab that and take it, put it into the movie, I suspect, at some point.
There you go. Variety of choice there. We've got an annual report and a potential future Hollywood movie.
You heard it here first.
Yeah. Another great episode. Thank you so much. Really, really enjoyed it. It's been an absolute pleasure doing these with you, and I look forward to the final one on the episode. Thank you.
Thanks, Lee.
Thanks, Lee.
Well, that's it for today. And in our next episode, Judith and Rosemary will share the day in the life of a fund manager. What do fund managers do on a daily basis? It will be another insightful episode that reveals how two seasoned fund managers think and how they view investing for the long term. To learn more about Rosemary, Judith and Downing, please visit www.downingfundmanagers.co.uk. All the links are just below in the show notes. And if you like what you heard, please subscribe and leave us a comment. The more feedback we get, the more value we can offer. And thank you for listening. We look forward to speaking to you in our next episode, and I hope you have a great day. Bye for now.